Yeah, that must have been 2022. Yeah, you were there with your all of your equipment. So,
Yeah, yeah, I've been showing my truck there for about 10 years now, but
yeah.
I think you and I met at the Sirius XM booth, if I remember
Oh,
so.
that's right. We were both on the show. Yeah.
Yeah, yeah, fantastic. Um, for those that don't know you, tell us a little bit about yourself.
Yeah. So I'm Aaron Terrazas. I'm an economist. I've worked across a variety of industries. The reason that Dean and I know each other is I was kind of the director of economic research at Convoy, for about almost 4 years. Before I left. Beyond that, I've been an economist at Zillow, the housing website, at Glassdoor, kind of the recruiting website, and then started my career at the Treasury Department in DC.
Yeah, fantastic experience. I remember reading one of your papers very early on during the pandemic when we were all trying to make sense of the market. I think you put a great paper out. I think it was titled "Freight Industry Recessions and the Business Cycle." Must have been
Yeah,
back in, was it 2019? Could it have been way back then when you
yeah,
started this?
probably. Yeah, yeah,
Yeah. Looking forward to talking a bit more about this because we've had quite an unusual freight cycle in maybe the last two,
yeah.
possibly entering into another one. But love to hear your perspective on where we are right now. That'll be our question of the week. So
Sounds great.
we'll bring Aaron back a bit later. Let's start off with a quick market update on where we are right now. We're almost at the end of July. Hard to believe the market is moving so quickly through the year. Spot rates down across the board. All three equipment types down a penny last week, pretty much along seasonal lines. Market rates for dry van in particular, and even reefer, are within about 1% of where they were in the last 2 years. So a lot of seasonality, although there is not a lot of volatility in the market right now. Diesel prices, of course, continue to climb. Back where they were this time last year, they're up about 36 cents a gallon since June 2. A lot of that's attributed to the rise in diesel prices, in crude prices, up about $10 a barrel since May. That's impacted small carrier profitability. High ultra-low sulfur diesel prices have eroded profit margins against falling rates. Average operating costs for long-haul carriers, if we assume they're about $1.86 a mile, excluding any fuel discounts, that's the average, the national average diesel price in that $1.86. Carriers are kind of getting by, barely breaking even. Not a fantastic year if you think about the national average. Of course, carriers are making much more than the break-even cost, depending on what market they're running in. Some early numbers came out around the English language proficiency debacle. And exactly as I predicted 3 months ago, it's had little to no impact on the market in terms of spot rates or rates in general and safety metrics. The market's moving exactly as it was before. A lot of the claims of shippers self-policing seem to be immaterial. There were about, if we look at the first month of ELP inspections, 2.4% of inspections had an English language proficiency violation. There were 4,900 of that, 3,700 passed, which is about 0.06%. 0.06%, or about 1,200 of those inspections resulted in a driver being placed out of service. To put that into context, though, 1,220 drivers being put out of service is 0.03% of total drivers in the market for for-hire and flatbed and private fleet flatbed reefer dry van. So not a lot of impact there, exactly as expected. But it's a big week. Aaron's going to touch on some of this. There's a slew of crucial economic data coming out this week around jobs, inflations, GDP, I think, comes out this week. Some corporate earnings on the truckload carrier side and some consumer confidence numbers. I think we may even know if the Fed's going to impact interest rates positively or negatively later in the week. So we'll get back to that a little bit later. Let's start off with the load to truck ratio in dry van. Load post volumes both saw about a 6% decrease last week. Dry van load to truck ratio ended the week fairly stable, not much difference at about 6.09. In the refrigerated market, not much change either in the load to truck ratio. It's still sitting just over 10.06. Load post volumes were down about 20% last week. Again, the market is cooling as it does seasonally every year after July 4, especially in the spot market. Flatbed, the load to truck ratio was up about 4% last week to 22.49. Flatbed load post volumes remain mostly flat last week, but they're about 18% higher than where they were this time last year. Quick look at our spot rates across the market. In dry van, spot rates were down a penny per mile last week, averaging $1.65. That's excluding fuel. It's about 3 cents a mile higher than where they were this time last year. On our top 50 lanes, based on load volume, not load post-load volume, rates were down a penny per mile to $2 per mile. It's about 35 cents a mile higher than the national average. And for those carriers that operate in the 13 key Midwest states, or bellwether states as we call them, they're about 45% of loads moved in our market, and they're a very strong indicator of national trends. Rates were down 3 cents a mile on a 1% lower volume of loads moved. The average rate for carriers in our bellwether states was $1.86, which is 21 cents a mile above the national average. Quick look at refrigerated. Rates fell for the third week in a row. Again, no surprise. They normally do that this time of the year, down a penny to just over $1.96. That's about 2 cents a mile higher than this time last year and slightly above where we were in 2023. And lastly, the national average flatbed rate, excluding fuel, saw a slight decrease last week. It dropped by just over a penny per mile, in fact, about 1.4 cents, so almost 1.5. Despite the decline, though, rates are still about 10 cents a mile higher than the same week last year, sitting about 4 cents a mile higher than in 2023. All right, quick look at our forecast. This is our ratecast forecast out 35 days. It's what's in green on the charts in front of you. The blue line is the long-term historical rate for loads moved over 550 miles, excluding fuel. And the green forecast is bounded by yellow and red upper and lower forecast bands. So let's start with dry van. Ratecasts expect rates relatively flat out to the end of August at $1.65 a mile. Assuming they make that number, that'll be about 3 cents a mile higher than where they were last year. The low case scenario has rates down 6, high case up 7. In refrigerated market, spot rates expected to be up 4 cents a mile. I'm not sure that's quite where we'll land. I think there'll be a lot more softness in the market by the time we get to the end of August. Rates are expected to be $1.99 per mile by the end of August. That'll be about 2 cents per mile higher than where they were last year. Low case has rates down 2, high case up 10. And in flatbed, pretty much exactly as we expect all the way through the end of August, early September, rates do slide south. Freightcast expect rates down 6 to August 28 at $1.99, excluding fuel. That'll still be about 7 cents a mile higher than where they were last year. The low case in red has rates down 11. High case has rates down about a penny. All right, so that's the end of the forecast and market update. You can catch the full version of this at dat.com/market update tonight. Let's bring Aaron back in. Aaron, simple question, lots to talk about here, but where do you think we are in this current freight market cycle?
Yeah, obviously this is kind of the million-dollar question.
Yeah.
And it really takes me back to some of the research that you mentioned earlier from my time at Convoy. This was just such a fun question to work on. The idea of freight cycles really took me back to like a lot of the literature on macro cycles, and that's how I began to approach it. I'm sure we'll have a chance to go into the details of that later. But the short story is that I don't necessarily think there's like even a fixed or stable duration for these cycles. Sure, there's an average, but that average is a huge range around it, and it's not necessarily stable over time. So what we're really looking for when we think about a turning point in the cycle is an unanticipated shock, an upward or downward shock to demand, an upward or downward shock to supply. Maybe I'm not being creative enough. Kind of risk folks are always it's important to be creative, but I don't see an imminent big shock on the horizon. Demand sure has been volatile and jumpy, but trending softer. Feels like that's likely to continue. Supply has been gradually contracting. You mentioned the English language kind of mandate. But they're not necessarily enough to flip the margin, and in some ways they're moving in the same direction. Supply is contracting a little bit as demand is contracting. So overall, I don't see the market flipping on the near horizon. In some ways it feels like this current holding pattern continues. And I think this idea of the economy being stuck or locked in, kind of in this, gear and unable to shift, that's something we see all over the place right now. We see it in housing, we see it in labor markets. So it feels natural that we'd also see it in the freight market, kind of the idea of stuck at this equilibrium and nothing really kind of going up or down.
Yeah.
Nervousness. So.
Yeah, I think that's a pretty good take. One of the things I went back and read some of your earlier work, which I was kind of fascinated. You're talking about freight recessions do not necessarily coincide with broader economic downturn terms, and when they don't, they're very short-lived. Is that that still hold true?
Yeah, I mean, I think the reality of broader macro cycles, is everyone is unique. There's unique risk factors that emerge, and so it's hard to say. I think in those of you and those of us who follow economic commentary will hear all sorts of different ideas about what triggers or what causes the recessions and booms. Is it, does freight predict downturns in the economy? Does housing predict downturns in the economy? Does oil predict downturns in the economy? And I think if you look back far enough, you've heard every single story out there. And the reality is every downturn is unique. Industries have their own boom and bust cycle. The freight industry certainly has its own boom and bust cycle. But in some ways, when we talk about this single industry as a cause or a predictor of the broader cycle, that's overfitting on our last experience. In 2009 to 2014, there were a ton of economic papers about how housing predicts the boom and bust cycle. In the 1970s and 80s, there were a ton of papers about how oil predicts the economic cycle. So I'm just always skeptical about single factors. The economy is a lot more complicated than a single industry.
Yeah, but it seems to be even more complicated in recent times, especially because of the pandemic. It seems to be there's some things fundamentally broken in the economy, especially in the freight market, compared to how we would normally think about it. Is that sort of accurate?
I'm not sure broken is the word I would use. I would say change. There's change, and when we think about kind of forecasting, particularly forecasting cycles, an underlying assumption that almost no one talks about is that the world is stable. And that the economic processes are stable and unchanging in the background. We know that's not true. We know kind of there's been these massive shifts in trade patterns and consumer patterns, in kind of regulatory. All of that stuff is level shifts, it's slope shifts, and so I think take a sector like the finance industry. It was a big mindset shift for the finance industry to stop thinking about perfectly seeing the future and instead start building real-time systems to adapt to market conditions. And it feels like, all of us struggle with that. Like the future is a wild, crazy place. Anyone who's lived through the past half decade just knows, like, I remember I started forecasting early in my career. I was at the Treasury Department. We were doing 10-year forecasts for the assumptions that go into the administration's budget. If you've ever done a 10-year forecast, it's just like a wildly humbling experience. You are so wrong all the time.
Yeah.
And I think kind of having humility about the future and saying, we have limited visibility into how a crazy world's going to adapt. Let's build an agile, adaptive system rather than pretend we're going to see 10 years into the future.
Yeah, these have been fascinating times. I think a lot of us would agree that we really don't know where this current market's going. If you had to say these are the sorts of things you should watch, what would be the signals you'd be looking for in terms of freight demand for the next 6 to 12 months?
Yeah, I mean, I think kind of all the signals are out there. Kind of you talk about them, lots of folks talk about them. And, I go back again to that literature on macro cycles. There's two big schools of thought. Are cycles driven by demand side factors? That's kind of an idea that economists have had since basically the 1930s. We look at aggregate demand in the economy, consumer spending, trade, fiscal kind of government spending. Does that drive cycles? And so I think obviously everyone watches that in the freight industry. What is happening to imports and exports? What is happening to manufacturing output? Something we try to do at Convoy was build like this aggregate freight demand index. What is coming out of factories? What is coming out of ports? What is coming, out of the warehouses? That's like a demand side. So, sure, watch all those demand side factors. In the 1970s, I'd say kind of economists began to have a little bit more nuanced view of business cycles, and we started to think about supply. Sometimes market downturns are caused by supply getting ahead of itself, producing too much. That was really a response to the oil shocks of the 1970s. And so I think kind of obviously, you just talked about kind of the effects on carrier supply when it comes to the language kind of stuff, kind of bankruptcies. So, I'm not sure right now I have a single metric kind of that's going to give us a long time, but yeah, all of those dashboard of metrics. When the Federal Reserve talks about predicting interest rates, they talk about a dashboard of metrics. And that's why you need to look at the demand side factors and supply side factors. Are they moving in the same direction? Are they moving in opposite directions?
Yeah, we see the market very flat. I mean, in fact, we went back and looked at our forecast in December last year, and we basically said the market we expect it to be fairly flat. If you drew a line between where rates start and where they end, fairly flat. Even new rates coming into routing guides based on recent carrier RFPs are plus or minus 1%. So shippers still largely have pricing power on the majority of lanes, but there's nothing on the horizon that we look at and say, here's a market inflection that's almost inevitable. In fact, Tim Denoyer at Act Research wrote a great piece on his July blog where he talked about we're entering a period of paybacks. And paybacks are because of a lot of the pull forward of freight, whether it be cross-border or international. And there's a payback period where we've already, assuming we've already moved that freight, that we'll see less volume. So I think he's accurate. We've been sort of forecasting fairly flat demand through year end, but the market's still oversupplied with capacity. And it doesn't matter what happens with rates. It just seems to be for every 10 carriers that leave, 9 join. And even large carriers are still struggling with where to find equilibrium.
Yeah, I think that's you're spot on. It feels like every little movement in supply is followed by a little adjustment in demand. We're not seeing big kind of adjustments that turn. So in some ways, supply and demand are chasing each other back and forth right now, and that's keeping prices flat. One's not getting way ahead of the other, like we saw obviously in March 2020, or in 2018.
Yeah, there's a kind of a phenomenon that we observed, and it's more anecdotal, but I do know a lot of carriers that were able to do this during the pandemic, pay off a lot of their debt because of the amount of money they made during that 21, early 22 period. They can essentially operate at much lower operating costs today. If you think about finance on a independent spot market carrier at about 30 cents a mile for a truck and trailer, if rates are $1.70, they're way lower than the market in terms of their ability to sustain themselves and perform in this market. I think there's a growing cohort of those. I don't know how to quantify that, but what we see in the market is this capacity that kind of jumps in and out of the market when the opportunity's there. And you see a lot more carriers they'll turn a one-day public holiday into a week-long time-off event. Yeah. And that's a new thing that I've observed since the pandemic. But again, anecdotal, very hard to quantify, but it partly explains why we're seeing overcapacity in the market, but rates kept relatively flat.
Yeah, no, that makes perfect sense. And this idea that kind of real-time visibility in some ways stabilizes the market because, supply can make small adjustments and keep better pace kind of with those demand shifts, as you said, kind of jump in temporarily to the market, exit kind of when things get a little soft. That flexibility fundamentally stabilizes prices in the long term.
Yeah, it's an interesting point about technology because the acceleration of technology, both during and post-pandemic, gave a lot more people visibility, particularly shippers. So shippers have a lot more transparency in the market now than they ever did. And I wonder if that's what's keeping a lid on the higher and lower margins that we would normally see in a freight market. Would you sort of concur with that?
Yeah, I mean, again, we kind of going back to the bigger picture and making the comparison to the broader economy, business cycle booms and busts have become less frequent, in the United States. In the early 1900s, we'd have them every couple of years. Now we have them roughly every decade. Our economic decision makers have been more adept at adjusting kind of the levers of supply and demand because they have that visibility. There's better data, kind of, finer tools to adjust. And so I think maybe we're starting to see that in the freight industry where both, the demand side, the shippers and the supply side, kind of the carriers can make lots of small adjustments rather than, scramble to make big adjustments in what they're offering.
That's a really good point. Part of me wonders if AI is having an impact. I know I use that term very broadly, but I know a lot of carriers are involving themselves in that technology. I wonder if that's starting to flatten out rates and the potential margins that you might have seen prior to this era that we're in.
Yeah, I mean, obviously, as you noted, that's like such a broad term
Yeah,
nowadays. Kind of,
yeah,
I think a lot of kind of folks would say AI has been around a decade in terms of machine learning and
right,
kind of statistical learning. It's
right.
kind of gone through different names. So, I think the most recent advances around generative AI and
Yep.
kind of the ability to forecast and make relationships that humans can't. Maybe that's leading to better decision making.
Right.
But I still think broadly when it comes to AI, we're still very much in early days, and a lot of
Yeah.
the talk we're seeing about productivity gains is maybe a little bit ahead of itself.
Yeah, I was interested in America. We were kind of inundated with truckers asking about, chatbots and can you build technology that allows something to negotiate on our behalf?
Mhm.
I mean, it's a whole new world. I'm not
Yeah,
sure to what end, but I wonder if that is having an impact on the kind of the auto. Oh, it's not quite right to say auto acceptance, but the lack of human intervention in the rate setting process.
yeah,
I wonder
yeah.
if
I
that.
mean,
Yeah.
potentially like that. That's kind of I'll say from my experience, kind of there's a difference between kind of taking an automated decision in small contexts or small decisions. When it comes to a big decision, people are still people. I think, I think back to every industry where I've worked, where there's kind of automated negotiation, some degree of automated negotiation or automated valuation in real estate, or or kind of in freight, or in compensation, with data glass door. Um, I think kind of there's a human tendency, particularly when it comes to executive and big decision makers. They will look at the outputs of a model, or a prediction, decide whether they believe it or not. And
Right.
if they don't believe it, they need a story,
Right.
for why they should believe it.
Right.
And I think that's kind of, maybe generative AI is going to get better at telling the stories about why to believe it, but it feels like that's a
Right.
very human skill to be
Yeah.
able to tell decision makers stories about why they should or should not believe a model prediction.
On Glassdoor, you did some work, or I guess it's tied directly to the supply side on the driver side. Was there anything
Mm.
there that you were able to glean about the supply of drivers in the market?
Yeah, I mean, kind of recently, I was also working with Gusto, which is like a small business kind of data provider, and kind of I think both in the Glassdoor and Gusto data, in some ways, I think kind of all of this technology, AI, has made it easier to run a small business than it used to be. They need to spend less time on accounting and paperwork and compliance and regulatory issues. And so in some ways, that could be contributing to the flexibility that you're talking about when it comes to carriers. It makes it easier to run multiple, businesses and jump in and jump out kind of when you have a chance. But yeah, I think broadly, when we speak at the labor market right now, one of my beliefs and something that I talk about a lot on LinkedIn is I think we're in a two-track labor market right now. I think, for decades we had this economy where skill, I hate the idea of skill, but highly educated workers, there was lots of demand and never enough supply of those workers. And at the opposite, end of the market, kind of less educated workers, it was the inverse of the case. There was always too much supply and never enough demand.
Mm,
In some ways, it feels like that's flipping right now. Maybe
mm,
it's AI, maybe it's interest rates, who knows what it is right now. But certainly at the high end of the market, the highly educated end of the market, kind of demand is soft and kind of supply is more plentiful.
mm,
And when it comes to skill regulated trades, things like kind of trucking, but also things like skilled construction,
mm,
kind of uh, hairstylists and manicures and stuff like that, where it's kind of
mm.
licensed at the state level. I think there is less supply and more demand,
Yeah.
at that level of labor. So again, two-track labor market. When we look at the headline BLS numbers, like the jobs numbers we'll get this Friday, everything looks like it's humming along okay, but that average, I feel like, is hiding two very different labor markets.
Yeah, that's very interesting. Tim Denoyer's driver supply level or supply index um, showed that the supply of drivers is decreasing for the first time in many years.
Yeah.
I was at a truck show on the weekend, and one of the things that really caught me by surprise was one of the best fleets in New England in terms of the nicest trucks. If that's an important reason about why you would go and work for someone, which it is, they struggle to find drivers to drive dump trucks around New England at
Yep.
$50 an hour. And that's not the first time I've heard that. One of the things operators tell me is not only is it hard to find drivers, they don't want to do what the job normally entails and are now starting to increasingly dictate their terms,
Wow.
which is
Yeah.
it's really interesting when you see that. But even going back years ago, one of the best looking managed flatbed fleets in the country, out in the Midwest, always struggled to find drivers, whereas decades ago in another generation, people would have given anything to drive one of those trucks over the road.
Yeah, I mean, I think kind of I certainly wrote a lot about driver shortages kind of during my time at Convoy, and it's I think the idea of labor shortages often gets simplified a little bit too much. It's it's not I can't find kind of a worker when I want it for the price I want it. It's a little bit more complex than that. I think it has to do with employee expectations. It has to do kind of with lifestyle flexibility. Some of the innovations around kind of more regional or short hauls as opposed to long hauls,
Yeah.
makes that kind of type of work more palatable to more types of folks.
Yeah.
And so yeah, I mean, I think kind of those shortages are there. You think about the trends in labor supply. Kind of right now, we've got I think something like 10 million projected more bachelor's plus workers over the next decade, and 9 million fewer under bachelor's workers over the next decade. So kind of an offset there. I don't think that trend's going to go away. It's probably going to accelerate what the dump truck fleet you're talking about is experiencing.
Yeah, very interesting. That kind of brings us up on time, Aaron. We could talk all day, and we need to get you back on once we get more economic information out. But how can people contact you if they'd like to learn more?
Yeah, I'm on LinkedIn, kind of Aaron Terrazas, kind of you can see my name, I guess, and I share kind of data about the labor market, kind of data again about these kind of 3 industries that I've worked in and passionate about, kind of real estate, logistics, freight, and the labor market. So it's an eclectic mix, but hopefully people find it interesting.
A valuable one nonetheless. I love your work, been a big fan of your work for many years. So appreciate you being on the show. A couple of shout outs very quickly before we drop off. Chris Kaplis is talking to Chad Ollison, CEO of AVRL, about dynamic pricing and advocating for the human in the loop approach, where brokers and analysts collaborate. Next week, good friend of mine, Ray Lampkins, he runs the That's Delivered podcast. He's also an overnight trucker in the LTL market. Don't forget the CVSA 7-day break safety week is on August 24. With that, another show is in the books. Thank you for watching. Be safe, be nice to everyone. We'll see you back here again next week at 10 a.m. Eastern, 7 a.m. Pacific.